Good afternoon, chart watchers. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, coming at you live from our global headquarters here in Redmond, Washington. Thanks so much, as always, for joining us on Market Watchers Live. It's always such a great opportunity to get in front of all of you and share observations, share thoughts, share ideas about what we're seeing in the markets and the charts and the signals and the techniques that you should be familiar with to have a good read on the market environment. Today's Fed Day, so that's certainly going to be dominating, hopefully, your thinking and market dynamics. Let's take a quick check-in on what the markets are doing here midday. Then we'll introduce our guest, Dave Landry. So quick check, down a little bit so far on the day. Looking at the market summary page on stock charts, the S&P down 26 basis points, up a little bit from a little earlier. The tech-heavy NASDAQ is leading the way down 37, just over 1/3% down. Going down, we have small caps down to the lower end. The Russell 2000 down almost 1%. The S&P 600 down 0.9%. Looking at the sectors, this is, in my opinion, over the last, couple weeks, thinking about whether we're in a sustained bull phase, whether we're going to push to new highs, or whether we're, need to be thinking a little more defensively. Looking at the read of the sectors a lot of times is an interesting one. So we have utilities, one of the two sectors up on the day at this point, up about 0.5%. Consumer staples just above flat for the day. And leading the way, lower energy once again after a huge run up on the jump in oil prices over the weekend, kind of settling back down here. Looking at industries, utilities, drug stocks, pharmaceuticals, up pretty good. And then at the bottom, I was interested to see broker-dealers. Obviously, those will be front and center when we're thinking about the impact of the Fed and what stocks potentially are going to be feeling the ramifications of that. Certainly something to pay attention to. The chart of the S&P 500 obviously is the key one to watch today, and a little later we're going to think a little bit more about how to digest the actions of the Fed in the form of the broad market chart. Right? How do we approach this from a technical perspective? So to start with that, I'd love to bring on our guest, Dave Landry. Those of you that don't know Dave, Dave will be hosting a show on StockCharts TV coming up very soon called Trading Simplified. Dave, thanks so much for joining us today. Appreciate it.
Great to be here, David. Thank you.
So, I'd love, it's going to be so exciting I know you're going to give us a preview about your show, Trading Simplified. And, you and I just spent a little bit of the weekend together down at the TSAA conference, and which was really, really cool to hear you present, hear you think about it. I'd love, before we get to that, how do you think about a day like today, right? Like the Fed, all eyes on the Fed. There's this, opportunity for a huge shock to the market one way or another. Is it business as usual for you in terms of your process, or do you do something different on a day like today?
For the most part, David, it's business as usual. I believe that news is noise, and I actually ignore all news. Now, that's not to say that I'm not going to initiate something like an hourly Forex position or something like that on a day like today. But as far as my longer term core trading, which is swing to intermediate term, if I have a setup for today and it triggers this morning, I'm going to go ahead and take it. If I have a stop and I get stopped out, so be it on existing positions. So I try to just completely avoid all that news. If you are going to do something like a day trade, or like I occasionally trade like an opening gap reversal, I've got to be a little bit more skeptical on something like that on a Fed day, or like I said earlier, a Forex trade or whatever. I can get into a lot of trouble. But as far as the swing to intermediate term, the longer term trading where the real money is, I try to not get caught up in something like a Fed day.
That's fantastic. I love that news is noise. I'm gonna steal that from you with credit. I will give you credit for that one. That's a good one though. I like that. I was always told forget the news, remember the chart, which is kind of, I guess, on the similar one to that. That's great guidance though in terms of just how to think about a day, because I think you're right. In some ways, you don't want to disrupt a really well thought out plan because of what might happen, right? And also just the fact that, I've always found that regardless of what happens, the reaction, the excitement, the interpretation, the fear, the greed, all that's going to be reflected in price, right? So if you have a good read on price and if you have a good platform or a good system to track price movements, then you should be fine, right?
Absolutely. And then obviously, there's a chance that you could get stopped out, but if you get stopped out, you get stopped out. One of the problems with momentum trading, and I was told to stop saying this, but it's true. It could be a little streaky at times. And we got, I hate to use the word luck, but we just was following our plan last week, and we had one go up about 60% in one day. Now, if that would have triggered today and it's Fed day and we decided not to take it, that one trade, which could make our whole year, we'd have missed that one trade. So once you start factoring in news, it gets really complicated really fast.
That's right. The conference that I mentioned, you and I were at the TSAA conference. Everyone on Monday on this show on Market Watchers Live actually did a quick recap on attending the conference, just shared some takeaways from Dave's presentation as well as others. So if you missed that, if you go on the YouTube channel for StockCharts TV, you're going to see the recording from Monday. I'd encourage you to do that if you haven't, just to learn from some others that have studied these things like Dave and others. And the presentation that comes to mind when you just mentioned momentum trading, Dave, was John Lewis from Dorsey Wright, who talked all about the momentum factor and exactly what you said. It in general over the long term has created great amounts of value, but the challenge in the short term, it can be noisy, right? You'll have periods of potential drawdown. You'll have periods where it's just not working. So, in your experience, and I don't want to get too ahead of ourselves, I'm dying to hear, how you're gonna approach your show, but how do you deal with periods like that? If you follow more of a momentum strategy, how do you deal mentally with the periods where it's just not working? I mean, how do you deal with that?
Yeah, I mean, it's tough. And it's one thing I was thinking about doing that presentation you spoke of is that I think the reason momentum works is because sometimes it doesn't. And people go off to change rainbows or chase methodologies or methodology surf, whatever the case may be during those times. And, let's be frank, it sucks when the momentum ends badly often. And in the end, it usually ends badly. So you just have to know that it comes with the territory and you have to be willing to accept that. And what I do with the money management is I'm taking fairly small position sizes, and then I'm also taking partial profits at a swing trade. So I'm scaling out if I'm right small, but hanging on just in case if I'm right big. And then through those drawdowns and all, the money management will help mitigate those drawdowns because there'll be a few big winners here and there, a few small winners here and there, and then getting stopped out at flat out losers. Now, the other thing that happens just real quick is that once you start getting stopped out on a lot of things, obviously your drawdown increases, but eventually if the market starts chopping around and momentum's no longer there, there's nothing to do but sit on your hands. So your equity curve flattens out when that happens, obviously, and then you just wait for the next big opportunity. And then I think it was Dakota in Market Wizards said you have to learn how to distinguish intuition from intuition, and that's a line I've used so much I've been quoted as me saying it, but no, it's Dakota. And that makes a lot of sense. And, it's during those times where you just have to sit on your hands, and it can be tough. And we're people of action. And as you and I were talking a lot about over the weekend, the trading psychology and the importance of it. And it's hard for somebody like you, who's a hard worker, me, and anyone else who is successful. We're hard workers. We're not made to sit on our hands and not do anything. Right. That's the thing to do.
Yeah, a lot of times people confuse trading or investing with action, right? And a lot of times, to be honest, I always found if you're doing it right, it should be boring at times. Right? There are times where you should not be compelled to take action. Well, Dave, we're going to bring you back in a minute. Hopefully, everyone realized what I just did, which is we have so much to learn from you today, but also for your show coming up in a couple weeks on Wednesdays. So, Dave, thanks again for joining us today. We'll bring you back after the break here a little later to get a preview of your upcoming show. Just to give you guys a sense of what's coming up over the next couple of weeks, on the 19th, on tomorrow, we have Julius de Kempenaar, the expert on sector rotation, founder of the RRG approach. So please join us for that. Grayson Rose from StockCharts.com, my colleague here in Redmond, will be joining us on the 23rd, on Monday, to give an update on what's going on with StockCharts. There's so many cool things happening with the product and things that I think you're all going to find really, really valuable. And then coming up on September 26th, Dan Russo from Chaikin Analytics, who is someone I've known for a number of years and is one of the more knowledgeable investors I've met, analysts I've met. So I think you'll have a lot to learn from that too. So, before we get back to Dave and think about his approach to trading, I just want to take a quick step back here. Obviously, it's Fed Day. The Fed result is going to come out very soon. So, what I wanted to share is just how do you approach that from a technical perspective? And I think Dave Landry's comment just from a few moments ago about how, at the end of the day, news is noise. And what happens at the end of the day. All of that's going to be reflected in price. So what do you do? So I think the other thing, Dave mentioned sort of holding off on maybe some significant, trades, maybe waiting just to see what happens. That's sort of what you're seeing. And if you look at the chart of the S&P 500, which I have on the screen now, you'll notice for the last couple of days, we really haven't gone anywhere. So, and that's incredibly normal to have a little bit of lighter volume, a little more range bound trading as we kind of, wait and see. We're in wait and see mode. This is looking at a little shorter term chart, a 5-minute chart looking at the last 3 days. Here's the choppiness that we've seen. So we sort of rallied into the close yesterday. We opened down today, quickly recovered. But if you look, we really haven't gone anywhere so far this morning. Sort of all eyes waiting for this announcement just after 2 o'clock to sort of see what's going to happen. So, how do you pay attention to this? How do you interpret this? So I will tell you this. Number one, the one chart I would recommend you look at is this one right here, which is just a daily chart of the S&P 500. I don't think you have to get super crazy with this. If you're not familiar with the Fed and what the announcement means and what the target rate means and the Board of Governors and what they do, I'd encourage you to read up a little bit just to understand what's happening. But to summarize, it's all about expectations, right? So, the base case from, people I talk to, from analysts and strategists is, about a 25 basis point cut would be pretty much expected, baked into the market today. Another 25 basis point cut likely in December, and then potentially another cut early in the beginning of 2020, the beginning of next year. So for a lot of investors, for a lot of strategists, a lot of big firms, that's sort of the base case. That's where they're thinking. And now it's all about what happens relative to that base case. Now that is, Fed 101. And I have to tell you, of course, this time is different because now we have a Fed Chairman Powell who is, coming with a different strategy. He's talking differently than other Fed chairmen and chairwomen have. You have a president who is, openly critiquing and commenting on what he's seeing from the Fed. So depending on what Powell and crew would do today, you'll see comments that have potential to move the market. So all of that is very much an unknown. What I will tell you is that price is king. And if you look at the chart of the S&P 500 and look at how the market reacts intraday, so I'm looking at a 5-minute chart. This is going to be what I have up when the Fed comes out, just to see if we break to new lows for the day, if we break out above the high from earlier this morning. That's sort of the range that we set in the first 30 minutes or so. I'm also going to be looking at the daily chart here to see, if we meaningfully break out of this range. And if there's a surprise, if it's something different than a 25 basis point cut, I think you'll see this move very, very quickly. Brings me back to the poll. If you've not had a chance to look at the poll question, please do so. I just want to ask real quickly where you think Powell and the Fed will come out today. And again, if you haven't had a chance, put in a vote, and we'll take a look at that at the end of the show just to see where we all are expecting the markets to happen today. To finish off this brief comment on technical analysis on a big day on the Fed day, I'm going to the Mindful Investor chart list. So my blog's called The Mindful Investor. If you've not seen this before, if you're not familiar with it, just shoot me an email. You can get to me at the final bar at StockCharts.com. That's the new email for our show coming up in a couple weeks, the Closing Bell Show. And I'll send you the link to this. You can save it to your own StockCharts account. But this is a series of charts that I look at every day, and it's the way to run down what's happening. I'll just very briefly show you 2 or 3 of those. One is the long-term trend. So I would remind you that even though this is a big day and with a potential shock to the markets up or down, the trend is the trend. So you always want to orient yourself to the long-term trend. So a weekly chart of the S&P 500 is still something I look at regularly, and we're in a consistent uptrend, higher highs and higher lows. And regardless of what happens in the short term, that's what you want to pay attention to. And the one other one I'll point out to you really quickly is just the breadth. So this is looking at the advanced decline line for the S&P, and then also for mid cap and small cap stocks, all going to new highs and just petering off a little bit. If those lines continue higher, that tells you that the breadth is fine, and that regardless of what happens today with the announcement, we're moving along just fine. We're going to take a quick break for a commercial. Come back with Dave Landry. Thanks so much, everyone. Hello, everyone. Welcome back to Market Watchers Live. It's Dave Keller from StockCharts.com. Thanks again, as always, for joining us on this Fed Day. We have a great guest today, Dave Landry, who's someone I've known for a number of years, and so excited that he will be joining StockCharts TV with a show called Trading Simplified. And Dave, thanks again for joining us. Dying to get a sense of where you're going to take your time with us on StockCharts TV.
Oh, thank you so much. Glad to be here, and I'm very excited to be joining StockCharts. When they asked me what I wanted to call a show, I thought for a little while. I was like, well, I want to talk about how trading doesn't have to be so complex and that you need to keep it simple and all these things. And then I realized that I had trademarked Trading Simplified, and I thought that might be a good name for the show. And I think that we all tend to make trading a little bit more complicated than we have to do. And trading isn't easy, but it's far from as difficult as many try to make it. Now, one thing I want to point out is it's not my way or the highway. There are many types, many styles of trading. This is just the best thing I've found after many years of grail hunting. I think we all go through a bit of a grail hunt early in the process. And I think the true enlightenment comes when you get out of that grail hunt hunting and just find something simple and stick with it. It's conceptually correct based on the psychology of the market's participants. And I'll touch upon that in just a few seconds. And also, I believe that regardless of your trading level, whether you're just getting started or you've been trading for a very long time, there's a piece of what I do that might help what you do become even better. I was working with, as I discussed at the conference in San Francisco, I was working with a hedge fund years ago, and he was impressed with the way I was doing certain little things where I thought everyone did, just very simple things. So a lot of that will come out in the show. Now, I'm not holier than thou, meaning that I get frustrated with the markets too. There's a lot of psychological issues, and Dave Keller, don't you chime in on those. But like everyone, I have a pulse, and just because I started trading doesn't mean I no longer have a pulse. So I get a little emotional in my trading here and there, and that's one reason that I spend a lot of time talking a lot about trading psychology, and nor do I claim to be the grand poobah. And as I often say, no one knows exactly what a market will do. Not you, not me, and certainly not the guy who screams on TV. Now, everybody's mostly excited about a methodology, and everybody's a bit of a setup junkie, and money management and mind or trading psychology tend to come down the road. In reality, we really need to flip that script and talk mostly about trading psychology and then money management and methodology. It's not exactly mechanical. You will have to learn some things and all, but that's fairly mechanical in the general scheme of things. I think if you can get your attitude right, then the others will fall into place. Now, you have to approach all this holistically. And when they first asked me to do the show, I assumed that they just wanted me to talk about charts. And I said, I do talk a lot about money management and psychology. And they said, that's great, Dave, whatever you think they need to know. And so I was really excited. And that's one reason I accepted the show, doing the show. But all three are intertwined, and no pun intended, but the way to look at that is like a three-stranded cord. And the great thing is about this is if you get better at one, you get better at all. And I can give you so many examples, but just a couple real quick. Let's say you got your money management right and you're only trading at a small size. Well, then any individual loss is not going to affect your psyche. And if you're in a proper mood, then you're more likely to follow your methodology. Last week, as I said earlier, we had a big winner on one day. And if I'd have been in the wrong mindset, I would have completely missed that trade if I'd have been frustrated at some trades past or whatever it might be. Now, the bottom line is to profit from a trade, any trade, you just have to catch a price move. I know, easier said than done. But because of that, I'm going to focus on price and only on price. As I just said, I'm going to ignore all the news except in maybe a rare case where I won't trade on the Fed day because I might be trying to implement a short-term strategy in Forex. But as far as my core methodology, what I'm going to mostly teach here at StockCharts.com, I'm going to completely ignore the news and focus on price and only price. And in fact, I don't even use volume in my analysis. And other than the occasional moving average, I don't use any indicators whatsoever. Now, in that technical analysis, again, I'm just going to use price, and I'm going to simplify that. Now, my methodology is simple. It's repeatable. I did a webinar a while back, and I talked about repeatability. And after the webinar, the host called me up and said, Dave, let's talk about this repeatability thing. And I just kind of said it in passing, and I didn't realize it was that big of a deal. But the more I thought about it, the more I realized how important repeatability is. And I'll just give you a quick story. Years ago, I was involved with a website, and there was a day trader, and he was putting out signals. And by the time the clients were taking the signals, he was already getting out. And a lot of clients got really frustrated really fast. Now, what he was doing was not disingenuous, I don't think. I think it's just the way it shook out. So everything I do, you should be able to repeat, whether you're following me directly or if you're just following the methodology in general and doing everything on your own. This is the open portfolio, and today we have two setups coming into today. And these setups, as you can see, were from last week. And then last week we have one here that triggered. This is the big winner from last week. It was on a recommended list for an entire week. I remember putting in orders day after day after day, thinking this thing will never trigger. So with my methodology, you should be able to repeat it. Everything is fully disclosed. I know some great people doing great things with proprietary indicators, but two things. One, if you don't fully understand how the indicator works, or two, if they die, then what's going to happen to your trading? So I would push you towards following someone who is fully disclosed. It doesn't have to be me, but in my case, everything I do is fully disclosed. Now, in a nutshell, if you think about technical analysis is reading the mindset of the market's participants, or reading the emotions of the market's participants, while at the same time embracing your own. And the reason technical analysis works is because the market participants often behave in an irrational manner. Yogi Berra once said, if the world were perfect, it wouldn't be. Well, if markets were perfect, they wouldn't exist. Now, everything that I do, there's a psychology behind the setup. So in making the methodology simplified, I believe that when you're describing a methodology, you should be able to put it on a cocktail napkin. And before my presentation I did last week at San Francisco, I got the crazy idea to make a cocktail napkin with my entire methodology. And that's pretty much it. Now, in the show, I'm going to talk about how to identify and stay with trends. And there are some very simple little tools. Like I said, other than the occasional moving average, I don't use any indicators whatsoever. But a moving average occasionally can be very helpful. There's a concept I'm going to use called Landry light, where the lows are greater than the moving average in uptrends, and then the highs are less than the moving average in downtrends. So when you see people like me and others present, and there's a moving average on the charts, check it out and see if that simple concept would keep you on the right side of the markets. Now, I have very simple setups that I'm going to use and show you exactly what I'm doing. And here's one of them here. This is what I call a trend knockout, where we're looking for a sharp sell-off after a strong trend, and that knocks out the nervous longs, and it also sucks in some eager shorts. Now, the other thing I want to do is anyone can show you trades in hindsight. In the show, I'm going to often show you what we're trading and why, and show you the setups. And then I'm going to show you everything, warts and all. So here's a trade right here. This is a gold trade that we're in. This is AUY. And it triggered, and it hasn't gotten to the initial profit target. It hasn't stopped out either. But right now, the trade is underwater. And if we have time later in the show, we'll go through the rest of the portfolio. Now, I'm going to show you some ridiculously simple setups in IPOs. And again, all I'm using is price and the occasional moving average. In this particular case, we're just using a closing high and a 5-day moving average, and that's it. And I'm often amazed that this stuff can actually work because it is so simple. In general, in methodology trades on a pullback, here's another IPO. This is actually an open trade. And you can see that it had a nice little uptrend, and then it triggered an entry. And then the money management, of course, which is crucial. We had a buy point, initial profit target, and a trailing stop in order to stay with that trend. I'm also going to get into market timing. This is the S&P 500. If you just look at the Landry light, meaning that the lows, again, are greater than the moving average, you could see that you would have stayed long for a long, long time. You would have gotten out of the way or short back in December. And then once again, you would be mostly long ever since. If you take a look at what that looks like on a longer term chart, you could see just using this one concept in and of itself will help to keep you on the right side of the market. And we're going to flesh all this out in a lot of detail. I'm also going to show you, easy for me to say, a simple system that uses the concept of daylight, and it beats buy and hold. And more importantly, it avoids extremely big drawdown. So this is one little piece of the puzzle that'll help us time the market. Again, money management is crucial, and I believe that money management will cure a multitude of sins. If you're doing the right thing and following the correct money management, no individual trade is going to take you out of business or destroy you from a psychological perspective. Now, one of the things that I've found over the years is the secret sauce to capturing big winners, and that's just using a ever-widening trailing stop, and then, of course, taking profits just in case you are right small, but being willing to stay with that position if you're right big. And I'll show you how to do that. That's one way to have your cake and eat it too. I think short-term trading is a great thing. Unfortunately, you don't make enough money and the risks are too big because the occasional black swan move can still occur. But the real money, again, is in longer-term trading. So these short-term trades, these swing trades, I'm slotted as a swing trader, and all my setups are based on a swing trade pattern. But I also want to be in that trade for a long, long time. And that might be 2 years or more. And that doesn't happen often, but occasionally does. And so I keep a piece of that on just in case that longer term trend continues. And that's where the real money is. Now, the psychology, I think, is the biggest piece when it comes to trading. And it's very important to get your psychology correct. And you got to realize that many times you're going to be your own worst enemy. And we're going to dig into that on a deep level. A while back, I decided I was going to write a course on trading psychology. And I started making my to-do list. I thought I could bang it out about a month or so. And I ended up within about 2 weeks, I had a list of what I wanted to cover, and it was 14 pages long. So there's quite a bit. But the bottom line is we're not made to trade both on a psychological level and on a physiological level. The same things that are keeping you alive and helping you function as a successful human being can often go against you. So we're going to talk a lot about that, how that the trading world and the real world are two completely different worlds, why it feels unnatural. And that's the biggest thing for me. It took me years to realize that, hey, it's supposed to feel unnatural because what we're doing is not a natural thing. And we might even delve a little bit into the neurology of why this all occurs. And the more you learn about all this, the more you feel normal in your trading. So we're going to talk about that and decisions and how they're all connected with emotions, that you can't eliminate your emotions, but you can learn to embrace them. The bottom line is what you're feeling is what makes you profitable. So if you're able to embrace your own emotions and let others be emotional in the market, that's what makes you profitable. And believe it or not, that's technical analysis, reading those emotions of those others. So the bottom line is we're trading traders, not markets. And one thing that if you could do to be successful, it's a little cliche, but if you could pick the best, leave the rest, plan your trade your plan, and then after you do all that, do a post-mortem to make sure you did follow the process, you'll be very successful. And we're going to dissect all of these in the show. The other thing I'm going to do is I'm working on a new studio, so hopefully this will allow us to live stream and do some really fun things live. But that's going to be down the road and something that I'm pretty excited about. And last but not least is you. So if you want to see something in the show, please let me know, and then we'll have some open segments where we can take a look at your stock picks, answer your questions, and so on and so forth. The bottom line is trading is far from easy, but it's not nearly as difficult as many try to make it. So join me to make trading simplified. Okay, that's it, Dave. That's the show.
That's fantastic, Dave. I was taking notes as you were talking, and I'm happy to report I've got about 8 pages of things that I would love to ask you about. What, just to start with, at the very end, you talked about a post-mortem, right? So you talked about, planning things out, trading, and then the post-mortem, and then rinse and repeat and kind of cycle it back. Can you talk a little bit more, just what does your post-mortem look like? So if you had a trade you were reviewing, how would you kind of approach that? What constitutes that review for you?
Well, that's a great question. And that came up, and that's one of those things and that's why I love to teach is like, I'm asked to flesh out things that I might not think about or think about enough. And I think the answer there is, if you truly know your methodology, the post-mortem should be pretty easy. And what I do is I just back the chart out to the date of the trade, and I look at it, and I kind of try to imagine best I can, like time traveling, and say, okay, I'm just seeing this trade for the first time. Should I have taken this trade? And obviously you're going to see it with a lot more clarity, of course, in hindsight, because you know the outcome. But you need to look at it and honestly ask yourself, it's like, boy, this stock was trending. It was persisting higher. It was accelerating higher. I had my setup like that TKO, for instance, mentioned earlier. It was a nice wide range bar down. The stock in general, again, didn't look like an electrocardiogram and all over the place. All these pieces fit. Then you need to pat yourself on the back if and only if you followed your plan, regardless of the plan. Like I said, in San Francisco, outcomes are noisy, and sometimes bad trades have good outcomes and good trades have bad outcomes. And if you could figure out how to wrap your head around that and separate the luck from skill, you'll be incredibly successful. And I think that we can dissect these things and go back to the original trades and take a look at them. And then if possible, we can maybe interact with the StockCharts viewers, and we'll take a look at the trades ahead of time. So I call that like a pre-mortem, like, okay, make sure we definitely do have the best trade going in.
Yeah, let's go ahead and lock these things up before death if we could, right? That would be good. But no, listen, I think the interactive nature of StockCharts TV in general has been a fantastic experience, just to allow people to listen and then actually interact with you. It's going to be such a cool feature of the show. I'm really excited for you and for that. When you talked about your own methodology, you keep coming back to the simple nature of it. And you also hit on the fact that it's repeatable, which I want to just touch on really, really briefly, because I've found, I've worked a lot with more quantitative strategists that are really just trying to design mathematically, statistical systems. And the repeatability, the robustness of what they're trying to do becomes a challenge, right? So you have something that looks really good on paper, you actually put it into practice, and then it just completely bombs miserably. So how do you, before, as a pre-mortem exercise, how do you make sure that what you're doing is going to be repeatable or maximize the potential that it is going to be repeatable? How do you think about that?
Well, one thing would be deliberate practice. And I look at about 2,000 charts every day. And if I see a stock that takes off without me, I ask myself, could I and should I have caught that big move? Did I have a pattern there? Is there a new possible pattern there? And I go through all this mental list every time I look at these charts. And over the years, I've learned to be able to look at quite a few charts over a very short period of time. So I think that's a big help right there in knowing what should work and what shouldn't. And then there are plenty of repeatable patterns. So once you begin to see this pattern recur over and over again, for instance, like the Trig Knockout, I kept noticing there'd be a big wide range down in these really good looking stocks. And then all of a sudden the next day the stock will go straight up again. So it's just a matter of observations. Getting your reps in is vitally important. I often say I've never met an unsuccessful paper trader, and some guy came up to me and it's like, well, I'm unsuccessful. It's like, well, how long have you been trading? He said 2 weeks. It's like, no, that's not how it works, Beatrice. That's not how any of this works. So give it time. And then, if you have something simple, you can know whether it works or not. Like you talked about earlier, the points and all, it's like, well, I can't speak for all of them, but I would imagine that in the case, like you said, well, where it doesn't work in real time is that they curve fit to the prior data. And, the future is always going to be different than the past, obviously.
It's so funny. It reminds me of when, I'm a student pilot, as I think you and I have talked about before, and I'll never forget, I had about 50 hours trying to fly an airplane and, learning a lot of tough lessons of just how you deal with when the plane isn't, is doing something you're not ready for it to do. And I talked to someone who said, well, I'd probably be great at it. I've been, playing flight simulator games for years. And I was like, well, when you're in the air and your heart's in your throat because you just lost 1,000 feet, it's a little different than, than doing it. So I think you're right. I think the reps, the experience of trying to do it live, I think you're right. That's where you really start to learn some of the lessons for sure. Can I just pivot just a little bit? And I won't ask you how many years you've been doing this, but I know it's been more than a couple that you've had a great career of just trying to learn these lessons, and the stuff you're sharing comes from, your own experiences. Can you talk just a little bit, how has your approach changed, or maybe more to the point, how has the change in market structures, things like high frequency trading, just the participants, algorithmic trading, all of that, has that affected what you're doing? Or are you finding that the tools you're using now are kind of similar to what you've been using for years? Or has that changed at all over time?
No, that's a great question. And that's what's exciting for me. And somebody pointed out who didn't know me, they went and did a lot of research on the internet, and they found some posts back from the 90s and in the early 2000s. And I was saying the same thing that I'm saying now. The only thing that may have changed a little bit, I'm using the same exact patterns. That TKO, I came up with that probably in 1998, maybe. And it's the same exact pattern. Now, the only thing that I might be doing a little bit differently is a very small tweak. Like, since the markets can be a little bit noisier or a little bit noisier than they were, I'll use a somewhat wider entry as opposed to getting it right above that high. Maybe my stops are slightly looser than they used to be. My trailing stops might be a little bit more liberal than they used to be. But these are very, very minor tweaks. The same patterns that I used way back then, I'm still using today. And a case in point, for instance, like bow ties, another one of my patterns that I discovered back in the 90s. I saw the market roll over in 2000. I saw it roll back up with the pattern in, 2007. Roll back over again in 2007. And then the 2002, 2003 bottom, we had another one of those signals. So I find that if you come up with something very simple that's conceptually correct, then it should last for a long, long time, because in general, the human nature never changes. The quants and all this other stuff comes and goes. I remember years ago, there was these spreaders. They were just spreading like crazy on everything. And that was the rage. And those guys have dried up. So just stick with something simple, longer term, and I think you'll do just fine.
It's funny, you shared how, your methodology is simple and repeatable, and those are not mutually exclusive, I think, right? I mean, the more simple that you approach it, by definition, the chance of it being more repeatable, it goes up by a factor of a great amount, right? I mean, because the more complicated, the more steps you have in a process, then the more it's probably not going to apply to some other areas. So I think that those are two really good things to keep in mind. It strikes me, I brought up just on the screen for everyone, a quick candle glance looking at some of the Dow stocks and where they're at over the last year. So with your methodology, which thanks so much for kind of sharing just a simple version of sort of how you think about things and how you'll dig into them, have you found with certain sectors, with certain types of names, that approach tends to be better? And the reason why I ask is because, at this point where people are sort of wondering, are we ready to put our foot on the gas with tech and communication services, or is it more lightening up, going more defensive, something like utilities? Is how you think of the market. Does it tend to work across sectors, across market cap styles, or are there certain sectors, like more volatile ones, where it just seems to work better, seems to chart better in your work?
Well, in general, on the upside, I like inefficient markets where the inefficiencies aren't priced, where the efficiency isn't priced in. So the stocks that have a lot of analysts and a lot of people trading them, thick volume, those have the efficiency priced into them. Now, a lot of times they can be priced for perfection, and they could be really good shorts. For instance, I'm short TSCO right now, which has probably tons of analysts and has tons and tons of volume. There are certain sectors that tend to be choppy, as you know, such as the energies, but there are times when the energies, like right now, can make really good moves. So in general, it does work. There are some sectors I'm not a huge fan of because they can be choppy. Educational stocks, which for some reason tend to be really choppy. I've done a lot of mechanical research in the past, and I find that they just don't trend that well, would be a good example of that. But in general, it does work across the board. And I think I think it was John was pointing out, talking about the momentum over the weekend, even some of these value stocks at some point in time can become momentum stocks.
Right. It's, it's interesting. I have the chart of Tractor Supply up, TSCO, which, I mean, congrats so far. That's a good trade at this point for sure.
Thank you.
One of my mentors, John Mendelson, who was at a number of places and longtime technical analyst, he always said, "I like trends that I don't need my glasses to see." And if you look at the chart of Tractor Supply again, I mean, there are so many times I feel like between July, August to now where you could have recognized that the stock is going down, right? And plenty of great triggers, breaking to new interim lows, breaking down through moving averages, all these breaking through support, all of that. But so often I feel like people miss the simplest kind of thing. I mean, it's like, take a step back. Is the thing going up or down? It's going down. Should you be long? Probably not, right? So that discussion, that thought process, I think people are going to get from your methodology and your discussions, which is great.
Yeah, one thing I didn't mention earlier, but the net price change is huge. I mean, look at this Tractor Supply. Look at let's just pick like a level like 108 and go back in time. It's like you go all the way back to May. Yeah. And we really haven't made much forward progress. And then notice in the classical technical analysis, you've got inverted cup and handle, and then some of my patterns, such as bow ties and what I call a first thrust, where you have a big thrust down from the highs. Notice it went from 114 down to 90 and change. And that was a big, that's where the chart becomes broken, pulls back a little bit, and then rolls right back over. And just keep it simple and try not to interject too much logic into the chart.
I love it. We're almost out of time, Dave, but I did want to ask you. It's funny. You and I both have an interest in market psychology, investor psychology, which is why I'm so excited to talk to you today and hear what you're going to share with all the viewers here in the coming weeks and months. But it strikes me when you look at behavioral finance, a lot of times it's all about behavioral biases, right? Like what we do wrong. Here are all the reasons why you make really dumb decisions with your money and with your investments and all this stuff. And it strikes me when you were talking about it in your presentation just now, you had things like embrace your emotions. Like it was much more of a positive thing on there's value in actually paying attention to how you're feeling. How can you just talk a little bit about that? I mean, how should a trader, how should an investor, should they try to, push their emotions completely out of the way and be as robotic as possible? Or is there a human element to what you do that you think has some value?
No, I think you have to embrace your emotions, and I think you have to realize that it's a natural. And then, as I said over the weekend, and I know we keep coming back to that, but it's fresh in my head. I talked about the trading psychology is kind of like peeling the onion, and then you understand. Once you understand the neurology involved, you're like, okay, wait a minute, I am prone to make snap decisions, so why don't I just count to 3 before making that trade? You and I were talking about flying a plane and how Greg Morris used to wind the clock to avoid crashing a plane, just to keep those emotions from taking over. And then another thing we talked about was acrasia, meaning that you might do the wrong thing over the short term, but that's going to have long-lasting effects. And you have to recognize when you're going to do that wrong thing to protect yourself from yourself. And sometimes that could be as easy as just turning off your screen so you're not making an unnecessary trade.
Right. It's fun. It's so funny. I always think of it. Someone years ago called looking at the markets too closely, getting caught up in the flickering ticks. And I think you get that idea, right? Where there's an ADD sort of mentality a lot of times, especially on a day like today when a lot of things can move very quickly. And it's so funny. A lot of times just turning the screen off, taking a deep breath, taking a step back, and it's probably could be one of the better things you could do, right? At a tough moment. Yeah,
and absolutely. And like this TSCO, I was watching it earlier, right before the show, and it began to drop, and I found myself getting a little excited about it. And I said, well, hang on, Dave. What do you want to do? And it's like, well, I want to take some profits. And where do you want to take them? So I just put in an order to take those profits should it hit the profit target. And my screen is literally turned off now with the screensaver went off. So I don't know what's going on. So it's like, if I sat there and watched it, it's like, okay, well, I got 5 points. Maybe it'll go 6, maybe it'll go 7, maybe it'll go 8. And then next thing you know, I've got 2 points, 1 point, and then maybe even losing money on the trade. But if I put an order in place, turn off the screen, go about my life, then if it hits a profit target, so be it. So that's another way to help remove some of those emotions from the screen.
Dave, what you're saying is I totally ruined your mojo by bringing the chart up in front of everyone. So you had to look at it. My bad. I won't do it again.
No, I'm glad to see it's working.
Dave, listen, this has been so cool to have you on the show. And listen, I mean, I can't speak for everyone, but I'm super jazzed to watch your show and to learn from you. I mean, every time I've heard you present, I pick up a couple other things. So listen, thanks again so much for coming on today. We'll look forward to seeing you again coming up soon. Your show launches Wednesdays at noon. It'll start October 2nd. So Dave, thanks again for coming on.
Oh, glad to be here. Thank you so much, David. Looking forward to it all too.
Perfect. Everyone, that was Dave Landry. Dave is going to have a show called Trading Simplified coming up here on StockCharts TV. It's part of the fall lineup that we're unleashing to all of you, not next week, but the week after, starting September 30th. And Dave's show will be every Wednesday at noon Eastern time, called Trading Simplified. So put it on your calendar now. It's going to be a really cool one to pay attention to. We're going to pivot now to the 10 and 10. This is where we go through tickers that you have sent in. And thanks everyone for throwing some questions in there. We've got a list of 10 stocks. We're going to start with Western Digital, I'm told. So I'll bring that up real quick. I heard that earlier. I brought it up just to check it out here. So, it's interesting. The tech sort of hardware space and like disk drive kind of manufacturers, they're one of the big movers today. And Western Dig down, about 1%. It had been a little worse, but it's kind of popped up a little bit. This for me, this is the type of chart looking at this that I think we're right at that. At the moment, it's a really important chart to watch right now with a potential, market shock coming in, and the open question of whether the market goes meaningfully to higher highs, is able to break through the highs from earlier in the summer, or we continue in sort of this corrective period. And I think if stocks like Western Digital can continue an uptrend, I think we're pretty good. It seems to me, right, we have this pattern of higher highs, higher lows. We've got plenty of space above the 50-day moving average. It's been a good run, but you can feel there can be a little bit of downside here. So for me, it's all about where we pull back to. In the short term, that 62.50 range, that's sort of the support level. Always looking to the left from the most recent bar. That's where I'm looking at support. And if we break that, you expect a little further downside. In my opinion, this 58.59 range is sort of the gap. That's the peak that we saw from earlier in the summer. That's where I'd be looking next.
All righty, so our next stock is going to be 1-800-Flowers, FLWS. Looks like it's having a rough couple months.
To say the least, right? So retailers in general, right, have been fairly challenged. This is a space that, have been doing very well. And this is the chart of 1-800-Flowers. You can see the relative strength here at the bottom, how it done very, very well through the beginning of the year. And actually, it started to outperform when the market was correcting in December. The market bottomed out in December. Look at how that sustained through the first, 3-4 months of the year. And then look how that completely reversed. And now, going back to the chart of Tractor Supply that Dave was talking about, right? We now have a pattern of lower highs, lower lows. We've broken through support, broken through the 200-day. In my opinion, this is the type of chart I think you have to hold off and just wait to see, where the downtrend continues to. Had been oversold recently, jumped up a little bit, and it certainly looks like you're threatening a break of support at 14.
All right, the next one's an energy stock, LNG. Looks a little bit better.
LNG, interesting. Energy has been obviously a really volatile space, and this is a stock that has essentially gone nowhere. If you look at the last 6, 7, 8 months, I mean, it's essentially been sideways. And if you look at the relative performance, you can see how that hurt you as a lot of other stocks had really been rallying. But look at how the relative performance has changed. And again, if you're, institutions pay a ton of attention to this line because that's how they're evaluated, that's how they're paid. If you're an individual, it's probably less meaningful, but it should be part of your toolkit because this tells you whether or not you're even looking at the right chart in the first place. You want to own stocks in general that are outperforming because that shows you they're in the right part of the market. That's certainly what's happened. The challenge for a lot of these energy names is, and LNG is no exception, it's rallied right up to an overbought level. It's not quite there. And I think if we tested overbought level, you'd expect a little bit of a pullback. The good news is we've just broken above the 200-day, and on any pullback, that's where I'd be looking, potentially to see if it looks like a good setup for another entry.
All right, the next one we got is Eldorado Gold Corporation, EGO, gold mining.
A stock called Ego. There's a psychological thing we could debate there, but we'll skip that for now. Gold stocks have actually been really, really compelling. Look at how well they've done. This is just one name, a less familiar name for probably many of us, but look at how the relative strength just rallied so strong in June, July, August. Just been a really consistent name. Now it's pulled off a little bit as, again, a lot of stocks are sort of back up to those highs. It's now pulled back to the 50-day. And if you've heard me on the show before, I often talk about the fat pitch chart. This is a chart that's had a nice long-term run. It's been weaker in the short term, pulled back to more of a viable level. In this case, it's pulled back to the 50-day moving average. So that's actually really compelling. The RSI has not gone below 40, and in a bull market phase, you want the RSI to remain above 40. That sort of tells you that, long and strong, things are okay. So overall, it looks really, really attractive. The only challenge, I would say, the reason why I would be maybe a little hesitant is this huge divergence. Look at the higher highs in price here in July and August, the lower peaks that you see in the RSI. A lot of times, that's what happens at a market top. So all you have to do is again, it could be fine. You just pay attention to a stop and definitely pay attention to support and see how we would break below it. If we do rally, I tell you what, $10 is often a really key psychological level to pay attention to.
All right, another gold mining stock, but this is AG, First Majestic Silver.
All right. So in the same general group, another materials name. This is one that's again, it's sort of in that really buyable sort of range where it's had a nice run. The trend overall is good. We haven't had a lower low, so we've remained above support, and it's pulled back a little bit. So it's sort of short-term weak, long-term strong. Tends to do pretty well. You have a similar divergence, a bearish divergence that you did on the gold, some of the gold stocks. So again, that's what concerns me with a lot of the materials names is that divergence, but. There are plenty of times when a market's in an extended uptrend, you will have divergences along the way. And all that a lot of times can tell you is that there's going to be a bit of a pullback, which arguably we've had. The RSI, you can see pulled back right around to 40. Overall looks really compelling as long as we remain above these previous lows and remain above support.
All right, the next one, PYX, Pyxis International Tobacco.
Boy, tobacco stocks have not been great, as I'm sure you can see from the fact that the chart has gone down. We often said in my previous role at Fidelity, never confuse the bottom of the page with support. So just because the stock has gone down is never a good time on its own to think about it, right? You want to make sure that there's more of a technical discipline. This one is interesting, though, because look at how it found support right where it did at the lows in December. So a lot of stocks are well above their lows from the end of last year. This is one that's actually pulled back right to that range. And you think of the risk reward on a chart like this. You have downside essentially down to the previous lows. From a technical perspective, that's pretty fair. Upside arguably to the previous highs that we had back here earlier in the year. So from a risk reward perspective, it's pretty attractive. Breaking above previous swing highs, a higher low. I mean, overall, this is a really interesting setup. The relative strength setting up for new high. This is probably one of the better technical setups that we've seen so far today.
Okay, our next one is a healthcare provider stock, BIOS, Option Care Health, Inc.
Right. So this is one. Look at the round trip it's had. This is the peak that we saw in December, in January. If you think about what the market has done, it's almost this flipped over, right? So the market kind of rallied right out of the December low, had a good first quarter. This stock, on the other hand, came down and continued lower. Look at how the relative strength just absolutely crushed you. You went from being up about 45, 50% to being down about 45% 4 months later. That hurts. So the question is, where are we now? And look at how this is reversed from a period of distribution to a period of accumulation. And for me, again, goes back to what Dave Landry said earlier. Keep it simple, right? So is this stock in an uptrend or downtrend? You don't need your glasses to see that it's been a consistent uptrend of higher highs, higher lows. Traded up a little bit today, but overall this trend is in great shape. And as long as we remain above the previous swing lows, you're in really good shape. So for me, major support around 320, but overall, really compelling. Only thing that concerns me is we're at this supply area, at this area of resistance where we found resistance before. So, upside from a risk reward perspective, fairly limited. So the previous chart we saw is probably a better setup than this.
Okay, we have QD. It's a financial stock, specialty finance, QD.
All right. So first financial we've looked at today. It's interesting. A lot of the banks like Goldman Sachs and others are really interesting to look at. Regional banks also in some really compelling trends. So if you haven't looked at those names in a lot, especially with the Fed meeting today and potential interest rate changes, really interesting charts to pay attention to. This one, QD, is an interesting one only because it is rotated. Look at the rotation we've had from an uptrend, higher highs and higher lows, this sort of consolidation phase in July and August, and now we've rotated down through support. So what concerns me on a chart like this is we've now broken through the most previous swing low. The trend is now reversed and it's gone downward. So, on a chart like this, what I would start to look for, you want some sort of accumulation. You want a signal that buyers are entering in, and then you want confirmation. So for me, sort of the ideal picture is a bit of a rally and then a higher low, and that's where I'd feel really comfortable taking a shot at something like this. But at this point, it's undeniably going down, and that's what would concern me here.
Ooh, there goes my alarm. Apparently, we got 5 minutes left, people. We have a really nice spread of stocks all over different groups. We have building materials next, so BLDR, Builders First Source.
Thank you. Builders First Source. It's hard to argue with the stock at new all-time highs, and again, just based on the window we're looking at here. If we look at a little longer-term view, here's a weekly chart. A little bit below. So we're testing this high from mid 2018. This is the all-time high around 23.50, right? So it's been a fantastic chart. Higher highs, higher lows. It's been a great uptrend. This on the looks a little maybe more clear on the weekly chart. You'd call this a bullish pennant pattern, right? So a nice run. You've had this consolidation of lower highs, higher lows. We've broken above that pattern, now broken above the previous swing highs. It's a great chart up and to the right. I think that's a really attractive setup. Interesting chart.
All right, our last one, mortgage REIT, IVR, Invesco Mortgage Capital.
Thank you for whoever asked about a REIT. And you caught with my conversation with Dave Landry. I love asking people about, it's so easy to get caught up in the headline names that everyone follows, things like tech, communication services, the big, the FANG stocks, all of that, banks and all that. But a lot of times what's great if you invest in stocks is there are always stocks doing a lot of different things. And if you limit your screening to just sectors that and companies that you're missing out on a whole bunch of potential movements. And in real estate, in some cases, has been one of the better sectors out there. Here, let's go back to a daily chart so we can get a read on the short-term price action. So on a relative basis, we can see that it had done really, really pretty well in the leading into August as markets sort of holding off. This was testing its relative highs, but then reversed lower. So other spots in real estate certainly have been better setups than this one in particular. Broken below the 200-day, now testing the 200-day from below, which is never my favorite way to sort of consider a stock. What's interesting here, though, is the fact that it was oversold here at support at the end of August. It was also at a similar oversold level here at the end of May. So we've tested support, same support from February and March. So that's a really consistent support level. That's sort of the floor that you'd pay attention to. That's the most recent swing low. As long as we remain above there, we're in pretty good shape. But boy, I'd love to see a nice breakout above the previous highs, which we're arguably getting kind of close to doing. That was the 10 and 10, everyone. What a great group of stocks. Thanks, everyone, for putting those in there. And again, parts of StockCharts TV like this, where we really get to sort of go back and forth and think about what we're seeing is really, really helpful. So I hope that was a good exercise for all of you. Keep other tickers in mind. Send them into us next time if we didn't get to it this time. Want to do just a quick final check on the markets at this point. We're holding in just fine, leading into the Fed decision, just a little over an hour away. So all eyes there. The S&P down 32 bips here at the 0.2996. So we'll see where we're at. Thanks for voting in the poll. 75% of us, 3 out of 4, say we're going to lower by 25 basis points. And as I mentioned earlier, boy, that's sort of the base case for most people. And this shows you how, if it's different than that, how surprised we're all going to be. And so again, if that happens, that's sort of what's priced in. So I'm not surprised that's what we said. Only 4% of you said we might lower by 50 basis points. I had a number of strategists that talk about that, the potential of that happening. And boy, if that would be significant. We'll start to see some movements there. Finishing off the hour here, I just want to remind everyone about what's coming up the next couple days. Julius DeKempener coming up on the 19th, talking about sector rotation. No better time to hear from him than now. Coming up next week, we have Grayson Rose on the 23rd on Monday. Next Thursday, we have Dan Russo from Chaikin Analytics. Those are all really solid presenters and solid speakers. So I hope you'll keep that in mind. Leading up to Fed Day, just one final comment. Thanks again for Dave Landry for coming on today. I want to remind all of you, the best thing you can do, keep it simple. Pay attention to the chart of the S&P. Look at how things are breaking relative to the news that we have, and that's going to be your best tool in your toolkit. Don't get so caught up in the headlines that you forget to keep it simple. Look at the price. Look at where it's moving. We always like to have a survey, just getting some feedback on how we're doing with the shows. So please take a moment if you haven't already and fill that out for us as we start to launch some new shows. Always interested in getting your feedback. This is Dave Keller from StockCharts in Redmond, Washington. Have a great day, everyone.